Hi guys, welcome back to my channel. Kelvin here. So recently, I've been seeing more and more people telling me not to buy the dip. And before you'll be like, oh, you say chicken genius Koko? No, I'm not talking about him in particular. Wells Fargo has been saying not to buy the dip since February. BlackRock says that they are not buying the dip. Morgan Stanley says think twice before buying the dip. Now, I'm sure all of them are very good at timing the market. That's why they are not buying the dip yet. And I'm also sure most of you guys have perfect timing too. 100% confirm plus chop. But in this video, I want to take a look into this whole idea of don't buy the dip. Is this really a good strategy? Or maybe, there's a tiny chance that this strategy is bad. But before I start, I would greatly appreciate it if you can help to tap the like button and subscribe if you haven't done so. Let's get this channel to 100k subscribers by this year end. In return, I will show you a dog and some ducklings. Alright, let's start right now. Okay, there are a few reasons why experts are telling us not to buy the dip. First, high inflation. Chicken Genius Koko first warned us about this around 3 months ago in March. This whole inflation problem came from the post-pandemic demand and the Russia-Ukraine war. Right now, inflation has risen to 8.6%. The highest it has ever been since 40 years ago. And we are already starting to see crazy stuff. Oil price had gone up to $120 per barrel. The last time it was this high was during the 2008 financial crisis. Food prices are soaring. Shelter costs are rising at the fastest pace in 31 years. And that brings me to the second reason. BlackRock feels that the Fed might raise interest rates too high. So here's how this works. When inflation is high, the Fed will have to raise interest rates to bring down the inflation. Because, you know, magic. Just kidding. Because when interest rates go up, the cost of borrowing goes up, which will discourage consumer and business spending. And when people spend less, inflation will go down. But here's the problem. If the Fed raises interest rates a bit, it's actually not enough to fight the 8.6% inflation. But if the Fed raises interest rates too much, it will shock the economy into a recession. Powell has already said that he can't guarantee a soft landing. He'd be like, print money, I can, but soft landing, I try. The Fed had already raised interest rates 3 times. First, it was 25 basis points, then 50 basis points, and now 75 basis points. But there's still a lot more upside, with Bullard wanting to raise rates to 3.5% by this year end. And that will be bad news for companies in many ways, because the debts will get more expensive and people will spend less, which leads to lower earnings. On a big picture, it can lead to recessions. Third, BlackRock feels that even though stocks have fallen by a lot, valuations are still not cheap yet. In a video, Joseph Carlson pointed out that the market can fall another 20% from here. Here, we can see that in recessions, company earnings will almost always fall. But right now, the market is still expecting companies to make more money. With a possible recession coming, rising interest rates, and inflation that's going out of control, company valuations may go even cheaper. Fourth, Wells Fargo says that there's too much uncertainty. Due to how connected the world is, the war has caused a lot of side effects. Rising commodity prices, inflation, supply shortage, and food shortage crisis. With both sides not wanting to give up, NATO has already warned that the war can easily drag on for years. Wars are unpredictable and anything can happen. Maybe more countries join in and lead to World War III, or Russia totally cuts off oil to Europe, or maybe launch nukes all around the world. Might as well, right? Because of all these uncertainties, it might not be a good time to buy the dip now. Quick pause, just in case you haven't heard, Webull is the latest stockbroker in Singapore. With Webull, you can buy your US stocks, US options, and Hong Kong stocks for a low fee of $0. Yes, you heard that right. That's $0. They also have fractional shares, which lets you buy your stocks with just $5 angpao money. Then, of course, you might be wondering, what's their welcome gift? I'm glad you asked. If you sign up with my link down below, deposit at least $2,000, then make 6 buy trades on either US stocks, ETFs, or options, you'll get $100 worth of Apple shares. This promotion ends on 30th June, yeah? With that being said, let's get back to the video. So, these are a few reasons why the experts are telling us not to buy the dip yet. But now, here are a few reasons why you should buy the dip. First, they may be wrong. I asked you guys, when will you start buying the dip? And not surprisingly, many of you guys will buy when Chicken Genius says so. This is actually a good strategy if you believe that he can time the bottom well. But let's see how accurate experts' predictions are. A guy on Reddit named NotJobs went and analyzed financial analysts' buy and sell recommendations. He found that for buy recommendations, analysts were able to outperform the S&P 500 by only a bit. But for sell recommendations, they weren't that accurate. After telling you to sell, the stocks actually went up instead. At the same time, the US government and even the Fed themselves thought that inflation would never go out of control, which obviously they were wrong. Meanwhile, Michael Burry, the guy who is shouting about the crash coming every other day, tried to short Tesla and paper-handed when Tesla went to all-time highs. What about Chicken Genius Gogo? Most of the time, he's right. He's right about Tesla, he was right about 7 Square, UpG, Lemonade. His option trades are very accurate. And of course, he was right about the market crashing. But he can still be wrong a tiny amount of time, like Palantir and Nano. Don't get me wrong, I'm not making fun of them. All of them are definitely experts, way more expert than me and you. But the thing is, even if you get your theories right, weird stuff can still happen. If the Fed didn't announce that they were raising rates back in November, Palantir would have already reached $60. If the Fed hadn't started printing money in March 2020, we would not have recovered so fast. If China governments hadn't done their crackdowns, you would have seen Chinese stocks going all the way to the moon. If the war hadn't happened, Tesla might even be 100k by now. You never know. Second, when to buy the dip. This is the 2007 financial crisis. If you wanted to buy the dip, where would you have bought? Would you buy here when it starts to fall? Buy here when it fell 20%? Or what about here after a big drop? Or maybe here when the Fed announced their financial stability plan? How will you know that this is the perfect place to buy? Or maybe buy here after it has recovered. But it could just be another relief rally. Same for this 2000 dot-com bubble. There were so many relief rallies along the way down. How would you know where's the market bottom? When I ask you guys when are you going to buy the dip, some people say that they will start buying when things start getting better. That might be a bad idea because of something called efficient market hypothesis. The market is very efficient in pricing in news. That's why when the Fed announced a 75 basis point hike, the markets went up. Or that's why after the Ukraine war started, the market went up instead. If you were to wait for good news to start buying, it may be already too late because the market has already priced this in much faster than you. The best time to buy is not when things get better. It is when things are at its worst. Also, just know that if you try to time the market and miss only 10 best days out of a 20-year period, your returns would have already dropped by half. And to make things worse, the 10 best days usually happen within 2 weeks of the 10 worst days, making it super impossible to time the market. Next, this time is different. Right now, experts are telling us that inflation will go out of control. Interest rates are going to be very high. Recession is coming soon, or even worse, a possible stagflation, where GDP is declining, unemployment going up, and inflation going to the moon. Everyone be like, this time is different. I have a very bad feeling about this. The market will crash super hard. Okay, let me show you an article by Morningstar. Here, you can see that there's always something scary going on, whether it's World War, Great Depression, even more World Wars, Cold War, Vietnam War, dot-com bubble, Great Financial Crisis. In every single event, there's something to be worried about. In 2020, you were worried that the virus would be deadly, and you wouldn't be able to get the vaccines out in time. We were also worried that businesses like hotels and airlines could go bankrupt. In 2007, we were worried that financial institutions would collapse. Unemployment would go sky high. All the way back to the Cold War, which lasted several decades. There's real danger that the world could end because, nuclear missiles. Even from 2009 all the way to 2020, where it was the greatest bull run ever, everyone is still worried that a crash will come. This time is different. That time was different. Every time is different. And yet, every time the market just comes back. This just tells me one thing. Even though things may seem bad with everything going on, this crash is just another crash in the grand scheme of things. Next, BlackRock says not to buy because valuations can get cheaper. But let me show you something. Right now, Amazon has dropped to 2020 levels. Tesla dropped to 2020 levels. PayPal dropped to 2018 levels. Ask yourself this, have all these companies grown in the past few years? Apple have increased their earnings. Google have improved their financials. Amazon is earning more money now. And Tesla have turned profitable. So yes, valuations can get cheaper. But right now, valuations are already cheaper. And based on history, discounts like that don't usually last long. On average, it takes about 603 days or 1.7 years for it to go back to all-time high. In the best case scenario, it can recover within 3 months. So the risk is that while you are waiting for a bigger dip, you might end up missing the boat if the market suddenly goes back up. So those are the reasons why you should buy the dip. Okay, here are my thoughts. Personally, I believe that the market can absolutely go down even more. Inflation is still high. Interest rates can go up a lot more. And the war doesn't seem like it's ending soon. But even so, I'm still buying. And no, it's not because I'm crazy. Here's why. Chances like this don't come very often. Even though there are a lot of bear markets every few years, the truth is, in the past 70 years, there have only been a few times where the market dropped by more than 30%. The rest are just a small 20% drop. While I can try to time the market, I can easily end up timing the market wrongly and miss a lifetime opportunity to buy the dip. Personally, I'd rather not risk missing this chance. So I'll just keep dollar cost averaging in no matter what. What happens is that over time, I will get an average price of the entire dip. It's definitely not the cheapest price, but it's also not the worst price. I do that because I know eventually when the market recovers, I did not miss buying the dip. Anyway, that's all for today. But are you buying the dip? Do let me know down below. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.